Greetings, market rebels. Welcome to this week's macro measure. I'm Wayne. My partner Ryan's working on something right now. I'm sure of that. And let's get into things. This is going to be a snooze fest. I'm just warning you at the top here. Here's the trusty disclaimer. Here is the trusty intellectual property rights notice. And then here is this week's notes, which are all on one page, but there's quite a few. So I'm going to leave them there. I put them together as best I could. Got to do a little explaining while maybe you take a snapshot of this, but I'm in kind of an emergency backup mode to exaggerate a little bit, and so I'm working outside of my office and just in a tough spot with not all my equipment, and actually not anywhere near all my equipment, unfortunately. So because of that and other things that are going on, mainly that I've got a lot of work to do today, I'm going to combine both sector situation and macro measure. Again, I'm just swamped with preparation for a friend who's helping me to refurbish my office. And that includes having to run a lot of cables through walls where there's a lot of other things like, I think property, what am I saying? Property. Sorry. A lot of other things like pipes and things like that. So I don't want to belabor that, but I've just got a lot of sort of tough wiring and stuff like that happening. And then there'll be some just, aesthetic work and all that. So we're going to do the best I can. So that's up more than long enough. I'm going to try to go through all this real quick. I'll go through this. I'll try to then go through some tabs, and then we'll go through the charts. And I would just say that this is really becoming incredibly interesting. There's a lot of arguments that can be made, I think, both in support of what's happening and against what's happening in this market. And it's honestly very, very counterbalanced. So let's see. Where can I pick things up? So yeah, I'm going to try to talk about where we are, and then talk about this point counterpoint stuff. And I think you have to just go back to objectivity in trading what we see. That's really become certainly the rebel pit mantra, and it's really what we also espouse across most services. And just to reiterate, early innings macro hype is often a buy, and we've seen that, right? We've seen some incredible moves, and that's why we try to say, right, trade what you see, right? So, because otherwise, if you stand back and say, "Wow, there's so many things wrong," and there are, and it can just become even more wrong or out of control, and you can miss out on a lot of opportunities. And we don't want to do that, right? We're, as traders, we don't want to do that. So it's sometimes you just have to go with the flow, really against all better judgment, and you can still do very well. So that's probably one of the main themes of where we are, and just trying to be objective and saying, wow, things are just becoming more and more detached. So I think the market is just versus the economy, and a lot of things I see that I'll share, some of which I'll share, I should say. This is just becoming more detached. That's not unusual. The trends are still up, and there's really nothing that's cracked. So there's really more upside ahead if the market can muster it, right? There's plenty of room, I think, on a lot of these charts, the important charts, to just keep going. Maybe as crazy as that may sound. I'm not predicting that. I'm just saying that it's there in my mind, technically. But at the same time, so is the risk of a dislocation where they just push this too far away from realities. They get things too stretched. And then you start to suddenly, on some sort of a news event, more than likely, or what have you, there's this massive dislocation that just you start to get this rollover that's ugly, quick and ugly. At least for starters. So I think that there's noisy sectors and breadth issues in the market. I think you probably have heard that. And by the way, in terms of this video, it's hope you have coffee ready, because I think it's going to be a pretty long one. So you can stay awake through all this nonsense, but which is my own fault. But there's just a lot out there, and I can only cover so much, but I really don't want to leave too much uncovered. So I think fundamentally, there's just further problems. The technicals are problematic to an extent as well, and so the risks are growing, and the lower sooner part two argument appears to have been premature again. I have to remember that this can persist, though, right? The megas can mask what is really happening. And remember, the market is not the economy. So, and despite all the big tech layoffs, of which I have a tab to show some of, basically, the market likes that, right? Because that ensures more beat the number, not ensures, but aids the more beat the number games that happen in quarters to come, right? So, as we've been saying, there's really great looking big picture stuff in the charts. And so the Mag 7 basket looks very good still. I mean, that just looks like it broke out, and there's a lot of support and force behind the breakout to me, of course. But remember that we did view these many times in the recent months, and we saw how there's been really big picture potential on these charts. They look really good. That there's really possibility for a major kind of bull market like expansion despite everything, which is really what makes the game hard for people that try to think about it. And I don't blame you on that. It just, it is part of it. But I think if you realize that staying abreast is smart, and that helps you respect risk and be disciplined in your trading as you trade the bull side, I think that's what we use it for. That's what we try to use it for. And this way you don't get caught off guard. Anyway, Elliott Wave gang, as we've been noting too, they appear to be a little early given the push we've seen. And that's, this tends to happen, and it tends to be contrarian where they get out ahead. They start talking about a terminal wave. And a lot of them are not even criticizing them, bright people. They believe in Elliott Wave, very, very strongly. And it is a great way. I think a lot of times in retrospect, you can see a lot of truth in Elliott Wave. It's just tough in real time sometimes with Elliott Wave. But again, it doesn't mean you don't use it or what have you. It's just that when these guys get early, it can be very contrarian, where it helps. I shouldn't say it helps, but it's sort of a marker where they start to talk bad about the market, and then the market starts to really go bonkers. It's happened in my career several times. So big picture stuff, it's not something that happens every year. It's more like something that happens every several years, maybe like every 5 years or so. Anyway, major index ETFs also still look stellar, but they're overbought in some ways. As many of you know, IBM is the outcast. That's problematic because, right, if there really is this rip-roaring economy under the surface, which, again, I don't think a lot of us believe in, and ultimately the market will have a day of reckoning if things continue to deteriorate in the economy in a big way, and the market continues to rally. So that's happened many times. It's all about when, right? It's all in the timing, but IWM could still go, and we'll look at those technicals. You can't, the earnings situation there isn't good, and rates being where they aren't good, and where those companies were at sort of from a health perspective recently has not been good. But basically, right, when you start getting money chasing all over the place, they might start chasing that at some point and blast it off, and it may be really out of touch with reality. But again, a lot of things get that way, and on the way to that, though, you can do very well playing the long side. It just got to be smart about it. So the other thing that helps the gang out, I think, is that this rally seems to me, at least, to be more hated than loved. And so when that's the case, you usually get further follow through. So that's what I think, right, sets up. These are some of the counterpoints, right, where you could say, well, there's this, that, and the other problem I see, but there's also factors like that help the bulls. The dumb money feeling FOMO in a big way would almost be a counterpoint, right, to the rally seems more hated than loved, because the dumb money's apparently really pouring in here. That's what Wall Street calls it anyway. And they're chasing. There's a lot of chasing of this AI situation. And so we're getting some of that kind of behavior, and there's reports we see when things start getting a little haywire, to say the least. Also, the government, if a real strong economy doesn't emerge, or at least a stable economy doesn't emerge, this is going to look really bad in retrospect, because the government data and reports are now really being mocked by a lot of people, a lot of Wall Street types, just calling it as they see it, and they think it's diverging. A lot of these things are diverging too much from reality. I have a bunch of tabs to cover At the same time, despite everything, right, financial conditions have remain really the easiest they've been in 2 years. So superficially, right, the Fed's doing this and that to curb inflation, and they're going to bring the rate of inflation down and that kind of a thing. And that really should subdue things in theory. But because of what the administration's doing, they're really working at cross purposes from the Fed's superficial sort of surface level goals, right? So in a weird, strange way, though, the administration, by I think fudging these numbers too much, is really hurting their own chances at a rates reduction. Usually, the Fed, historically, the argument's always been when you get too close to the election, the Fed usually tries to claim that they're apolitical, so they don't touch rates really in the last few months leading up. So if you're not going to get anything in March, and maybe it takes May or later, right? That really doesn't help the situation, because it takes a little while for the full effects of a rate reduction to kick in, just like it takes a while for the full effects of rate increases to really impact the economy as well. As usual, right, the gang has used these EPS reactions to their advantage. So this is what we always warn about. I know I belabor this, but this is what the game is, right? In the face of everything, they're going to put these absurd reactions together, and their deep pockets make that possible. And the fact that some people are really offsides or poorly positioned in some of these things just make this stuff possible. And then these major index ETFs, the weightings of some of these big things, like a Meta, for example, that's an incredible boost. I think we were talking about it on Cocktail. Maybe the biggest move of a large cap or mega cap company, biggest tack on of value ever. I think Greg or Ryan found a report on that later, but I think we were just saying it seemed like it was one of them, and it turned out that it was. Apparently, at least the data they found says it was. Anyway, I'm thinking, right, that there's still more room. We are short-term overbought in some ways. I still think there's more room. I'd be surprised if they let this thing just fall apart on the way to the NVIDIA EPS, because that's another chance to really move things up with gusto, and with malice. So what I would look at on that one would be, I know there's some other earnings we can't say they're all over with, but do we get a little bit of a sort of cooling off phase and then run into NVIDIA or pop into NVIDIA and then get the sell-off that people are probably already looking for? The second half, which we have a little graphic on, the second half is often not the best. So think late February, not often the best time to be long the market. It's got, I think, a negative performance on balance over the course of time. The dollar and the TNX 10-year yield, they really started to go bonkers late in the week. There was a lot of gnashing of teeth there, down big, then up big. So I think you got to keep that in mind, because those reverse back up. They're not really, I think, in a danger zone at this point yet. But if that starts to really begin to pop again, that could also be the sign of something or a problem. But some people are saying the reason why yields dipped at one point in a big way was because there was a flight to safety, flight to quality, for various reasons. Anyway, you're still trading around your EPS releases. You still have to be disciplined. You have nimble. I think the risks are really ratcheting up. And I think you have to remain focused and just don't go to sleep in this market. I think it's going to be still full of opportunities, but I also think it has the potential to be treacherous, more treacherous than it's been over the last 3 months. I think that period to me is coming up. So I think the next, let's say the next 2 to 3 months are shaping up to be more treacherous than the prior I'd say prior 3 months. So just have your put butterflies ready to go just in case. I'm going to stop the share. I'm going to get in with the tabs. Let me just take down the PowerPoint, and I'll start out with sharing this screen here. So let me get the right screen, which there's only one that I'm working with. So it should be showing our one of our newsletters. And so this is something that we've been including in the newsletter each and every week, just so folks have that reference for this fourth year of the presidential cycle. And we are obviously in year 4. There will be an election held this year. And you can see with what happens really in here's election day, and you can see what happens here right in late February. There tends to be this kind of a little bit of a weakness during this year where there's a presidential election. When you don't have the presidential election, it tends to be weak into the second half, even more so. So that's the big question, right? Does that seasonality play out overall? You could see that I would say January seasonality played out fairly well for a years with no election. Not really so much, but I guess to some degree, yes, for years with a presidential election. But this is really what we're coming into. Let's just establish where we are. And so part of establishing where we are is to appreciate a little bit more about the market in my mind. And this is the percent of stocks above their 20-day SMA. And you can see that from where we were at the end of the year, this is definitely corrected. It tried to bounce right in the second half of January, and it did, but now it's kind of coming back down again. So despite these new highs, this is not really a good sign, right? It's not anything to panic over, but it's not a great sign. The breadth under this move hasn't been that great. And a lot of you know that because you know that they've made some monster moves in some major weights, mainly Meta and others like that have really masked problematic performance under the surface. And this is really more of an early warning sign, something just to be cognizant of in my mind. I don't think this is anything you trade off of on Monday. It just let's establish where we are so we can appreciate risk. That's all I ever really try to do. Let me really assess the situation and try to handle it accordingly. Sometimes you're going to be more aggressive than others, and sometimes you're going to be more of a in out, kind of knowing that something could worsen. Let's go to the MMOH. This will be the percent of stocks above the 100, right? And this one is off the highs, but it's still hanging in there pretty well, right? Pretty well. If you want to make the other side of the argument, well, it could come down a lot. Did it get up to a level that's relatively rare? I wouldn't say that this is rare, but I would say that it was relatively rare, right? You don't see that kind of a level that we got late in the year all that often. I think this is a special time that's almost worth ignoring because you don't really have that COVID type stimulus happen that often to the degree that it did. But you can see really the last 10 years, you were, aside from the COVID madness, you were maybe near some of the most overdone levels that you get to. Then MMTH, excuse me. There you go on that one. And this one, this has definitely had moments where it's been higher. Okay, so this was getting up there, but it really wasn't anything extraordinary. It was high, but not extraordinary. But now, that is not really confirming with this. You're not seeing a lot of stocks power to new highs, despite what the indices, the major index ETFs, I should say, are doing. Now, I'm just going to leave this here where we were kind of in that extreme greed late in the year. We've kind of remained near extreme greed, which is, I think, a 75 or above on the faulty CNN view. But you've come off from there, but you're still closer into the greed situation. So 75 puts you in extreme. So you've had a couple of things that have backed you off, but as you would expect with what we've seen, things are not right. You're nowhere near where, hey, this is a great buy because we're near the lows. Right? There's a lot of fear out there. You look at some of these components that they've got, most of them are obviously going to be near extreme greed or definitely within greed. Now, this is another sort of counterbalance point in terms of where are we? Well, unfortunately, optimism just skyrocketed. So a lot of players came off the sidelines. The good news, though, is this is really the first spike. You come up here and see, right, look where we were last week. So this is really a strong spike, right? You can see just how much neutral declined by. And so a lot of people really switch camps from neutral, and a few people switch camps from bearish to, I guess, maybe neutral or bullish. Who knows? But the point is, right, on balance, you've got a lot of bullishness out there. It's not quite at the 1-year high, but it's up there. If we go, I think, to more historical sentiment data, yeah, I think I have to click on this. You'll see that this is the most bullish we've been since we were in the kind of teeth of that tremendous year-end push, right? So most bullish you've been in a while. So again, it just spiked back up. There's still potential there. Now we're going to cover all these tabs, of which there are many. Not going to play the video, but you might want to check this out just because they're starting to come up with new reasons to justify some of these valuations, and they're talking about price to innovation ratios and things like that. So maybe worth a look, but this is the kind of thing that often happens when you're in a phase like this where the market seems to be getting ahead of itself. It's based on this really big picture macro hype in the form of AI, and people start talking about things in that way, and you're kind of like, I don't know, another thing, just off the beaten path type stuff, came across this Tom McClellan setup. He's got the S&P there in black, and here's your Manheim Used Vehicle Index. So you can see that used car values are starting to really come down, and there has been a really good correlation, really, from 1997, according to him. And you can see that now, right, there's a massive divergence between stock prices and used car values. So again, this is probably due to the concentration and the hype. As I noted, there's a lot of people that are starting to really question what's happening. And because there was some real serious shenanigans that went on several years ago in recreational goods and vehicles, this was an area that was sort of bewilderingly skyrocketing. People were absolutely blown away by this when it happened before, but it's happening again, supposedly, that people are going bonkers to own RVs right now. Could be partially true. I don't know. I'm just saying that this has been used to fudge things in a big way before, and they're saying it may be happening again. There's job openings, right? Look at how the job openings have diverged from the market. So I think that bigger view on that one is pretty clear that usually there's a somewhat of a correlation, but you can see now there really is this divergence. So something to keep apprised of. Here's where the S&P is versus the rest of the world. So you can see at what kind of a ratio exists now, what kind of a premium there is for U.S. stocks. That's very high, right? You don't really see readings over the last, well, it's not quite 20, but over 15 years back, 15 to whatever, 18 years back. This is where the highest it's been. So they're really bidding these things up. And as we've been noting, the rest of the world, and I've got something about South Korea. I know Germany, a lot of the Europe not doing so well. We know China's problematic. It's just that this is why this is an extraordinary time to me. One reason, because it really isn't like a global participation. Hedge fund leverage is now hitting new highs. Okay, this is not, a lot of these things are not from, let's say, the last couple of days, but really from late last week when I had to travel for my family reasons. Anyway, you could see, right, the usual players now are overdoing themselves. So just keep that in mind. Again, that's contrarian because these guys are often wrong and they get themselves hurt with the aggressive games that they play. Then you see that there's been some days, right, things look wonderful. And then other trading days, things are really, you're kind of like, what's going on there? So there really isn't this consistent buying at these levels. It seems like you're getting these real big bursts. And I think a lot of that is, again, FOMO and poorly positioned shorts that happen to fight against these trends. And I guess some things never change. And then you have them scrambling to cover everything. there's another counterbalance. If you could say, well, there's some of this breadth isn't that great, but here's a number of at least technology stocks hitting a 252-day high. So that's one of your highest readings. The 31st most substantial level in history. Some of the best, right? Other than the post-COVID madness, you've got to go back really into the 90s to get a higher reading. So not something you see that often. So we all know that, but I mean, it's nice to put numbers on this, and tech has been the leader. Here is, again, more of the I'm calling shenanigans crowd, which is Kyle Bass, with the inflation magic that they pull off, where they just try to put forward numbers that everyone knows are just not realistic. But he's got a 40% inflation over the last 3 years combined. So this is the FHFA home price index. Here's your federal funds effective rate. This is what I was talking about when it comes to lag, right? These things are really going to be up there when these things. This is really up there, and when this starts to impact more, you'll potentially see a lot of trouble start to crop up. And I think some of it is, and some of these tabs are going to show that. I just don't have the time, and there's almost no way to put these in more of a logical order because there's so many of them. But here's what's been happening under the surface in terms of EPS revisions. So just give there's a really great a great situation right on your hands there, right, where what's going to happen. You got the big dogs up for the rest, doing this. So this is why people are so confused, I think. But you just have to remember those weightings in those major index ETFs of those big names are significant, right? And that really that's why Ryan talks about them all the time, and Greg does too. You can really get those overriding things and keep masking, right, what's happening underneath. Here's another complaint about the job situation. So full-time employment figures have plummeted, right? So this is that's really true from what we can tell, because so many of these things are so many of these so-called jobs are part-time, and a lot of them are just based on estimates from surveys, and it's really more of a situation where I think the establishment versus household. I think what they do is if someone's working 2 jobs, I think the establishment survey counts that as like two people working, whereas it's the same person working 2 jobs according to the household. And a lot of people have picked up a second job. So in terms of change in liquidity, though, this Lance Roberts piece, there's a big discrepancy right now, right, between the liquidity index and the market. And last time we were near this level, we got a nice correction in the market. So again, be prepared for that. People's historic savings rate are approaching historical lows probably because of the trouble they've been having. People, again, are draining their savings to a year low. And here is the highest monthly pace in terms of PCE increases, right? So you're getting things heading back up. Some people are complaining about the number. You'll get all that. You always have these people arguing or whatever. Sometimes I have problems with some things that get put out myself, but I don't really comment on 90% of the stuff that I think is a little sketchy. But people are basically, you're setting up for people are getting pressed, right? Here's this large cap versus micro cap growth stocks. You can see, right, how much of a divergence there is right now. Another massive divergence visually, though. You can see, again, here's your Russell 2000 EPS. And you can see that's the blue line. Look, this kind of explains why you would think at least part of the reason why IWM can't get out of its own way. But again, you got to just trade it if it happens. I mean, that's what you've got to do, and just appreciate the risk that probably the underlying situation doesn't really support a breakout, but that's not really going to stop these guys from breaking it out if they want to. The gang, of course, is who I'm referring to. here's your concentration and here's your extreme valuations, right? You've got to go back to the peak of the dot-com mania, which still takes my breath away when I think about it to this day because of how insane it was. But you may get something that exceeds that, right? In terms of how the semis are versus the S&P overall. We've seen that. We've been trying to trade these semis because they've been rocking and rolling, and there's been this bullish bias, and it's getting stretched and it's getting uh, vertical, but it's still there, and they might not be done. We'll have to see. Anyway, uh, the this is another Wayne Whaley. This is another performance, right? So if you get this kind of performance from 27th to the 15th, right, when the trailing quarter was up greater than 5% in the last 50 years, it tends to be right. It tends to be there tends to be some pretty good moves, right? So overall, I think it tends to be good over this trailing move. So this is you tend to get some big moves when that situation's in place. There's the noting on the financial conditions again. Let me just see if I can move this out of my way a little bit here. I think I've got the Zoom stuff is in my way. Here's your just a note because we get a lot of questions about gold and silver. I'm sorry, this isn't the gold. There is something coming up about gold, but the global liquidity again. This is the cycle. So this is a kind of another reason why if this does play out the cyclically the way that it has in the past to some degree, again, it's kind of messy. But if you do get that, and these governments find a way to kick the can and start doing the Keynesian stuff all over again, watch out because if you're a bear and you have a problem with what they're doing now, you'll be utterly bewildered if they really start to kick it in. Here's the investors being the most bullish they've been in 2 years. So be careful on this measure. So just be careful with that. That's coming from Vanguard. This is the Texas manufacturing, right? Collapsed in January. So these reports just keep coming out, and you just say, where's all the wonderfulness, right? There's too many things that are just not good. Here's Jamie Dimon. He's really stepped up with his criticisms. It seems like can't say he's wrong. He's talking about the global market rebellion over U.S. debt, and right, the way things are accelerating debt wise, it seems like we're about to be eaten alive. Here's your auto industry inventory to sales. So you can see, right, that inventory has really climbed versus sales. That's really extraordinary. Remember how all these, I guess, folks that were fleeing urban areas became big time buyers. Inventories were very low, sales were very brisk, so we were way down here, and now that's completely reversed and then some. So there you have it on that. Not a good sign because, believe it or not, the used car stuff tends to be pretty strong in terms of historical record from what I've been able to see from research folks have put out. So when that's sort of sending you warning signs, it seems to matter. Eventually, there's your money supply versus the stock market, right? So just remember, right, that if they do keep the liquidity, you can see, right, if they keep adding more currency, the trend is that stock prices just keep going up, which is why you've got to be careful. Another kind of important player, right, globally, Korea, maybe not the largest, but Korea. This is the bankruptcies are surging amid a perfect economic storm. So defaults, foreclosures, and bankruptcies. I don't see good things happening. So this is all happening in the U.S. Here's one. Let me move this out of the way again. So here's another one where you've got people's balances are really starting to tap, right, their credit, and the balances have really jumped, and you can see the rates that people are paying. So that's not a good situation. People are paying exorbitantly high interest rates to borrow on credit cards, right? That's not normally a good sign. You normally see these things spike up the way they have, or right in front of problematic times, and you're getting that in a big way. So again, don't think that really helps the things are wonderful argument. Just more about earnings getting cut, the earnings estimates, I should say, getting cut. So they always, everyone that's been around for more than 15 minutes knows that these guys are always overly optimistic and have to bring them down. And they're doing it. They have to, and it may or may not matter the way that they've got things going. Uh, Here's a big reason why a lot of people aren't feeling it. They're saying that 60% of the U.S. states are currently experiencing economic contraction. Well, they're saying just under 50, but the Philadelphia Reserve Bank of Philadelphia is saying 60%. I think. Where's that part of it? Yeah, there. So anyway, I don't know which report they're comparing to each other, but there's contraction there. Somewhere between 50 to 60% of states experiencing contraction. Let's just leave it at that, since we have so much to cover. This is another amazing thing, right? Where you've got to get back to the .com era in terms of these weightings. So that's a big problem. Ultimately, right? You can't just have a few stocks go up, even if they're tremendous companies, blah, 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 blah. And usually, and then mask everything for forever. But could happen. Just saying, it hasn't really been a great situation in the past when things have been so concentrated and dependent on companies the way that we're becoming right now. This is another situation where even though supposedly the unemployment rate has come down, the government's doing their thing in terms of increasing the deficit to keep things looking wonderful. And I think a lot of a lot of this stuff is government hiring. It's really not ideal type hiring. Another person questioning what's going on here. So they're talking about seasonal adjustments and things like that, and the large revisions downward, right? Which Ryan's tried to point out. Another problem where I guess the average Joe Jane is not, that's a U.S. Citizen is experiencing stagnation in terms of the jobs that have come online, and otherwise, right, folks that are effectively foreign-born workers, right, are doing much better. So that's why, again, so many people are complaining. Another reason we should say, right, here's the difference between your leading economic indicator index versus the S&P. Another massive divergence, right? So the track record's pretty good if you look at it overall there. So again, another reason to be concerned. Here's a list of some, not all, of your major layoffs, right, that have been happening. And you can see that some pretty big names, but remember, this is a sign, right, that things are pretty rough for some workers, which is never good. But these companies will find a way to help this get themselves beats in the future. And a lot of people just forget about all this and really don't care too much about it. In terms of it's a human situation, human cost, obviously, but it does help the bottom line ultimately at some point, which is what they're after. From what I've seen, there's been a lot of AI hype, but no company has been able to. We talked about this one already. No companies have really been able to say, well, we've been able to do so much with AI that now we're doing this, that, and the other thing, and that's helped us to really improve the bottom line. That hasn't been tied together yet. Maybe it will be soon. I don't know. But to this point, from what I've read, that's not the case. Soft survey data collapses, continues with Chicago PMI plunge, right? So there's signs, right, that things are not looking so wonderful at the moment on this soft data. The earnings recession, right? Again, you're talking about here's your income, net income. Look at all these kind of meandering their way lower, and yet you get this. But that's why you have to break this apart and say, okay, well, true, but the weightings of, if they were all equally weighted, it would be a problem. But the weightings of those major companies, those mega caps are huge, and so that can keep things buoyed, right? So, and then here's bank credit has collapsed. So this is another argument that they're making. So I don't know exactly what's going on here, but if this is accurate, right? Not normally a good sign when things get this dire in terms of credit being tapped. JP Morgan quants are probably early, but they're calling it, right, like a lot of our discussions that we've had in terms of you're kind of feeling a little .com-ish. They're saying, well, you might be right that you're feeling a little .com-ish based on the way things are playing out. We already talked about that one. One of the dupes I've got. Job openings are experiencing a significant decline, even as the market continues to move up. This is a pattern of divergence reminiscent of 2007 and 19. And that is a sign. So I think it's a sign. I try to keep an eye on that, and I think it has worked before. It's at least a reason to appreciate risk. Maybe you don't start shorting, but you should be appreciating that risks are building, I think. Initial and continuing job claims surge as layoffs accelerate, right? So you're getting back up there on that. The risk premium, U.S. equity risk premium, S&P 500 yield minus 3-month T-bill, right? You're down here. Notice, right, July of 07, notice summer of 2000, late summer 2000 as well. So not good times if you know what happened thereafter to the market. There's a crash happening, as if no one really seems to care, but there's a crash happening in commercial real estate, according to this, right? And the regional banks are feeling the pain. That's an area we keep mentioning. That could still be an issue that people have sort of forgotten about, but it could still become an issue. So another reason to stay on the ball. Civilian labor force keeps dropping 900 in the past 900K in the past 2 months. Meanwhile, there's your government employees. So the government just keeps adding more and more overhead. Meanwhile, right, in the private sector, you're seeing a different story. Here's the January payrolls with seasonal adjustment, right? Plus 365. January payrolls without seasonal adjustment, right? So this is where a lot of there's again, here's some arguments about this, that, but there's a lot of hocus pocus that goes on with these things, and you can look into them on your own. I've done it in times, and just more or less confirms, right, that there's just so much shenanigans that go on, and they don't care. No one cares. They kind of like look at it and say, well, I'll later on is when I'll worry about that. Here's another one. So this is pretty incredible that, right, out of all these companies that have reported, who make up the Russell 2000, they're saying quarter over quarter growth is down 53%. I mean, that's remarkable if true. Just remarkable. Let's see what this one is. Those forced to work part-time now to, I guess, make ends meet is at a 2-year high, 4.4 million. Again, not a great sign. Then as someone, if you want to look at this Chapwood index, you can. Ryan sent that one to me. This is going to give you an idea on what the true cost of living increase has been. And it's obviously going to be dramatically at odds each year with what the government's reporting, because they're trying to focus more on reality, right? This is not all massaged away or faked away. And so you could see that this is just, this is why people feel so squeezed, because we know that wages have not kept up with it. But that's the problem, right? And if you adjust a lot of these things for inflation, which they don't really do enough, you aren't really getting growth. It's not even just, it's not this administration alone. I can't remember one that didn't do stuff like this, but it might just be getting more egregious like everything else in this country as time goes on. Another criticism in terms of how they're making things up. Don't even want to belabor that. We talked about that enough. Market is soaring because AI hasn't displaced any jobs. Market is soaring because every tech company is betting AI will displace millions of jobs. That's the little funny one there. Stocks, right? Here's the 12-month forward earnings yield, less the 3-month U.S. Treasury bill, right? Stocks less than cash. And you can see, right, when you start getting down here into lower levels, you have problems in the market eventually. So it's not really a great timing situation, but extremely overbought on a weekly basis. I would say, this is from Lance Roberts, I would say we are overbought on a weekly basis. And on his view, it appears to be extreme, and his view may be a good one. On the basic view, I would say it's overbought. No question. I don't know if it's extreme yet. I would maybe kind of disagree a little bit on that one, but I'm not really, that's not what this video is about. I'm just trying to we haven't done this in a while, and I think it's important to understand what's happening with so many things diverging. And here's his point. He's still sticking. He's another person that's covering, right, that leading economic index versus the market, which is usually a pretty strong correlation. And it's really spread now at this point. So this is the only, what we're having is something kind of historic, right, where S&P jumps 1%, and there were 2 losers for every winner. The only other day was after Black Monday, right? And that's back in 1987, which I believe they call Black Monday. So it just has, it shows you that, right, that there's so many problems with so many other companies, but it's all being smoothed over by these heavy duty, big mega cap, mainly tech names. Let's see. Another divergence, right? Payrolls versus workers excluding multiple job holders. So there's a great example of people with part-time, people picking up part-time, the government claiming this is all wonderful. Meanwhile, I'm sure a lot of people would prefer not to have to work a second part-time job. And then this is just more of a touch of maybe, just maybe, inflation isn't going to be completely dead due to the price of shipping. So remember, that's a big part of the argument, that the rates lower sooner argument, and that may not be the case. So let me start out actually with 2 other important things to kind of set the table for, where are they? I think it's down here. I think I have it set up here. No, my guesses are never good. Is it this one? That's it. Okay, so I apologize. I can't get rid of volume. I'd like to just get rid of this for some reason, but it doesn't seem like it's letting me. Anyway, we're looking at the diamonds. It doesn't really, I'm going to switch over to other things. Let me see if I can remove. It won't let, it's not there, but it's not there, but it's there, unless it's on a different spot. And I don't see it anywhere else. So I'm not sure why the volume won't leave there. Where I'm just going to let it go in the interest of time. This is a really ugly view, right? It's kind of, I can understand if on your screen this looks like a mess, but I'm just going to try to point out that the way the colors are working on here, it's really in line with how I've always kept my moving averages. So I'll just tell you that the 20 is the light blue or cyan color. The gold is the 50. The red is the 100, and the purple violet color is the 200. But I just want to show you that on the 100 basis, if I look at the diamonds, right, if you go back really all these years, and I think we're going back, let me see, make sure I'm going back 10 years on the daily. It's only got me. I'll do max one day. Let's see how far it goes back. But I would just make the point that where we are not that in terms of like how stretched stocks are right now. This is essentially what we're getting at. How stretched stocks are from the 100 day. You are the most stretched you've been really since the very best part of the fall, which was of 22, right? But maybe more importantly, you don't really see many readings that are too far above here, right? So this is not really a spot that you stay at for very long, and there just aren't many readings that are too far above here. You've got one back here right before a massive plunge that started to happen in 2018 after the 17 run, late 17 run, which was absolutely amazing. There's another incredible high reached up in here during looks like 2020. That was probably right I guess the post-COVID situation where you got just everything screamed, but you don't have many other readings over the last, let's say, 7, 8, 9 years. So you're getting up there, and I could do this on SPY or QQQ. I don't want to belabor this, but you're going to see that some of these things are just really up there. They're not at the highest they've been, but they're in a territory that has to concern you. Because again, here for Qs, other than in the post-COVID, which I think you almost have to skip over, you maybe are at the highest reading you've had, again, since late 2017. And so you are getting really stretched. There's just really no way to say that you aren't. There's no way around it, that it just, that is where it is. And it holds true in most places. But what we have to do is balance that against, and I think I'll get off of this one. Let me just go into one other thing just to make this point for everyone. This might be it on, no, another bad guess. This one. Yeah, this is it. So I'm going to leave it on this one, but this is just, this is one of my breadth charts. It's just nothing fancy, but just want to show that here's your McClellan oscillator. Here's your McClellan summation index. And so that's sort of like this thing's kind of taking on a little bit more of a concerning look. That type of a mode is sort of developing here. So I think you have to be on guard for that right now, that there's a little bit of a sign that just like the sectors are not screaming, all of them are not screaming like they were higher, like they were in the fall. You're getting that here where you're just not getting all the sectors going, and a lot of this other stuff beneath the surface is really not there. Now, overall, advanced decline cumulative average still looks pretty good. I think stocks that are above certain SMAs, as we talked about, they're not looking terrible, right? But overall, there's just been this cooling off effect lately. And so with a lot of these earnings sort of already priced in, and great news and big jumps and all that stuff, and the second half of the month coming up, I think you've got to start being a little more cautious about things than maybe we have been in the past few weeks. So I just wanted to make that point up front, that with those kind of little just market breadth checks. But at the same time, I'm just going to remind everybody that we talked about this in the fall. We talked about it earlier this year, and I've kind of gotten away from it because I've had all kinds of different things happening in life. But the reality is, right, you kind of have this cup and handle, and you have this long-term trend. Excuse me. And here we are looking at the Qs, and the long-term trend is up, right? And that's the easiest thing to see. And they're making new all-time highs here. And so there's a lot more room if they want to take this situation up, then they can. So that's the big problem. If they want to take it up, they can. If you're one of these people that's doubting everything, right? There's a lot of room to go here. Doesn't mean we have to get there, but I'm just saying that the market usually finds a way, right? If you kind of trace out a channel and you say, well, the market's sort of trading within this channel, if it gets through the halfway point of the channel, which it's trying to do, I think, sort of like now, getting close to it, the chances of it really going up and ultimately hitting some of these higher, super high levels is pretty good historically. Again, not in every specific instance can I say that that's a lock or something. I'm just saying that overall, it's a pretty good track record from my recollection. And I think everyone that's been charting for a little while knows about the cup and handle pattern. And that is we've been talking about it. It's a good pattern, and it's probably bringing a lot of people in that are technically oriented. And you can see that it's broken out. Like we broke out, right? And now you're starting to really go. And this is why I'm not really saying this is like extremely overbought in a basic way. And Lance Roberts might have a really good indicator. I don't like what he does, so I'm not even being critical, but I'm just saying RSI says 72, 73. Nah, it's not that bad. I mean, it's overbought, but I mean, it's not that bad. We've seen much, and that's on a weekly basis. So we have to weigh, I think, objectively that this market looks really good, and it has this big story associated with it, which brings a lot of people in, and that can turn out to be a self-fulfilling prophecy when you have, Joe's six-pack and Jane's six-pack are sitting around talking about how AI is going to be wonderful for stocks, and it's going to, save these companies a lot of money, and the bottom lines are all going to improve, and it all very well may happen. Who knows? But at the same time, I wonder about the long-term ramifications of a lot of people losing their jobs. I'm not sure what happens there, but something doesn't seem like a good development from that perspective. But this thing's breaking out. The incoming trend was up into this. You had a nice corrective action, and now you push through. And I've got the extensions going up. I think I've talked about them before, and I always mention the closest one, because let's not get too far ahead of ourselves, and let's at least get to the next level before we start talking about the levels that are beyond that. But this looks really good. You have to, of course, right? You're still in the vicinity of the highest high previously, which is back here. You're not that far from there, right? So you were back in 21 in the Qs, 11/22/21, 2+ years ago. You topped out at 409-ish, and so you're about what 5% roughly speaking from there right now, looking like you could go a little bit further in the short term. And but big picture wise, I think there's a lot of potential left. A lot of potential left. And here's your monthly chart, something we don't look at every week, but I'm just trying to give everyone a little, well, Thinkorswim, I just don't like the way they scale. Sometimes they just scale so strangely for me, but you can see, right, you're at 68 on the monthly. So if you want to say, well, that's nearing overbought, but yeah, but look, it got to 77 here, right? So you've gotten to higher levels. Here's an 84, 85 reading on RSI on monthly. So yeah, you're at 68, but it can definitely get higher than this. That's why, again, I'm not really seeing it as extreme with my basic way of just viewing it through RSI. So I do think there's plenty of potential there. There's a lot of contrarian stuff that you've got to be on guard for, that it'll absolutely bewilder the living daylights out of people that are unwilling to go with it. They'll get super frustrated if they manage to pull this off. So again, I think it comes back to trade what you see. You may have major and legitimate qualms, right, with what's happening, but the way to make money from this is not to be short too early. And if we drop down to the daily, it's to be long early, right? And then when you feel like it's gotten insane and it's showing that way across the board, that might be the time. It doesn't have to get that way, but that's usually the time. And then aside from that, there's your daily right now. So again, the daily on the Qs is only 66 if I round it. So that's not overdone. Here's my line target that I've had for some time to keep extending it as time goes on. And that's up, another percent plus, which to me is completely possible. I mean, you could do that on Monday morning, by the way, who knows what they're going to do over the weekend. So my argument would be, if you've got all these problems with this market, and you certainly would have a sympathetic ear from me on that. And I think Ryan too, but in terms of trading it, what are you going to say that you don't like about this? You want to say, well, there's a little bit of a negative divergence on the RSI. Okay, I agree. We were concerned about that before, but you have to really get something has to crack, right? You really haven't been able to crack anything. You've got rising SMAs, even the shorties are all rising. What are you going to say? Well, this is my reason to sell. I think you've got to see some weakness develop that tells you that this might really be it. We might finally be on the verge of something. And that could be a news story. It could be, right, the dollar and yield spiking. It could be all those kind of things. So that's what you have to do. So there is your support line right there that I just added, the short-term trend. And you're right near the 15-day, which on this particular final candle is 420.2. So you need to fall 2% in my book as it stands now before you even start thinking about this thing's. That's how I would do it. That this thing's in trouble. Just because there's a negative divergence in RSI, I wouldn't do that. I wouldn't just start acting on that. So just kind of keep that in mind. I think you're going to see that it's similar across the board. It's not identical. And we'll talk about IWM and we'll talk about these sectors too. You can see there's more room on the trend line basis at resistance in the spiders, right? So they are at 68 as well. Really, it's the same crack of the 15 that I would be looking at if you want to fight this. But until it starts showing you some signs, remember that these divergences and negative breadth issues or different problems under the surface can crop up and they can persist, and the market will just continue to motor higher. It all comes back to if these guys can continue to levitate some of these bigger names. And just think about this, right? That Microsoft, things like Microsoft that kind of got hurt, they love this stock right now, right? All they really need to do is move up some of these names. That's all it is. Just think about that. Just keep that in mind, right? Even Apple, which looked horrible, look at that reversal. So just imagine, just imagine if they decide Apple's a value down here, and now we're going to start adding more Apple, or Microsoft is barely off the all-time high. We got to scramble to buy more. By the same token, you could get a little bit of backup in Meta, certainly, from where it got to. I wouldn't be shocked if that happened, but I don't know if it happens right away, but I wouldn't be shocked. But a lot of these other things just like Amazon, I don't even think is back at the all-time high. If we go and zoom out on this one, right, this has plenty more room if they want to start marking this one up. Yeah, see, that can go up another, what, $15, $16 roughly, just to get back to where it was. And that's not even really, if you adjust for inflation, it has to go higher than that. So that's what I've been trying to convey, that even the all-time highs are cheap on an inflated basis in a strange way. So if you take inflation into account, you've got to go. Now, it hasn't been something that it's been something that I've commented on. It wasn't I had thoughts that way, but I think I said that Michael Guyad guy was the one that I read something on because I was looking for it. He came out and said, yeah, you've got to be 10% higher roughly to really, that's just his number. But I mean, you've got to be higher for sure by a significant amount just to get yourself in the game in terms of a nominal versus actual new all-time high. So if I'm going to do the Mag 7. Well, you know what? We did everything. Let's do diamonds. The diamonds also have that nice weekly pattern. Then we'll do IWM. But the weekly pattern is a little bit different in diamonds. But overall, right, that's still bullish to me, where you consolidate for as long as it did for several years. And then you break out and make, after, right, an incoming uptrend, you correct, you consolidate, and then you start going again. That is another attempt, right, to launch a leg higher. They did kind of break out and they pulled back, right, very close to the former high, which we always try to note because it's a common thing. That reversed very strongly off of there. Look how that candle closed, right? So they got it above the all-time high, kind of came back, tested the all-time high, said, yeah, that's support, and it's been goose, goose, goose ever since, right? So you can't really say much about that. I think to me, it's a little crazy, but the pattern is different than S&P and Qs, but it still looks good. And here's your monthly, right? So if this thing, which has really been dogging it compared to the Qs, certainly, and certainly SMH, if this thing gets going, I mean, and just we extrapolate it, you're looking at nearly 45,000. And I think that, the administration seems to have a problem on their hands. And I think you can bet that if possible, this is what they're going to try to engineer. Yellen will try to engineer this at all costs before we get to the election. So keep that in mind, because there's a reason why I had to learn this the hard way. To me, there's a lot of silly stuff that goes on, but when you see it work more so than not by quite a bit, at some point you have to acknowledge that, yeah, that stuff actually does matter, even though it may be sort of nonsensical. Here's the IWM consolidation. And this is the big missing element, right? This is the outcast of the moment. This is us looking at it. You know what? I wanted to show the failure of the breakout and the near perfect, right, sort of false breakout, and then pull back. So this is, again, you have this really strong breakout. You think you've moved beyond those that former high right here, and the things are looking wonderful. Look where you were though on RSI. You were at 75 on the daily, and then you pull back, and the thing is, it's going to fill this gap. It's going to try to hold on and go. No, it weakened, right? But they found the 50 there in gold. They bounced it from the 50. You still have rising longer term SMAs in there. And so right now, this is becoming, to me, very interesting, because we just saw how poor profitability is in so many of these companies. We know that higher rates do not help these companies. And this stock is kind of a made up word sort of for this particular usage. The stock's triangulating here. It's basically, you can see that it's working its way into something resembling a triangle. And that means that there could be an explosive move that emerges from here at some point, because that's one reason why I really like to find triangles, because you do at times get very explosive moves. The other thing is that because the stock's ranges have sort of contracted, a lot of people do not really want to go long the volatility. So it's kind of a cool thing to be able to pick up volatility cheaply in front of what could be an explosive move. I mean, playing the game at the right time is more important than anything. But I think playing the game with super cheap IV at the right time is even better, right? That's really a winner. And you're about getting to where you're 3/4 of the way through this triangle. That's usually when you should be on guard for a possible breakout or breakdown. And the question may be related to what yields do. So if yields start to go up, maybe this thing has more downside. If yields roll over convincingly, maybe that starts to buoy this thing. And a lot of hey, we got to get ourselves some of that IWM, some of those small caps. Maybe that starts to become the next fever, because if you look at how far behind IWM is in performance, it's dramatic, right? I'm almost afraid to do that, because Thinkorswim gives me trouble when I do a comparison line for some reason. So I don't really want to play with that. It just, if that fouls up and Zoom gets me again, like it has been, then I'm really in trouble, since we haven't talked about the sectors yet. But let's talk about big picture stuff first. So let's look at the dollar. And I want to look at the Mag 7, and I want to look at the SMH. This is what I mean by that real strong reversal there. So this was really tricky stuff. This looked like it was going to go, but then it really faltered there for 2.5 weeks. And then Friday, this big, really kind of bullish engulfing reversal. So we'll see what that means. I mean, you could see it right, that it was correcting. It's been out of that channel. It's been in more of a short-term upward sloping channel overall. It did really close at the highest level it has in several months. So there are some good signs there, but you would think that doesn't portend very well for the metals, nor does it portend very well for stocks overall. The yields were also kind of a really interesting in the 10-year, something similar. Had this real serious plunge. And I'm like, wow, well, I guess it makes sense that, they're goosing stocks, because this yields are coming down, thinking, okay, somehow they've got to figure that these rates are coming down. But big reversal on Friday, could really be above many SMAs with just a little more push. So again, we know this is really a derivative, right? It's really the derivative of the 10-year. So you're deriving the value of this off of that. But if this does make a push, you can see that it's worked its way beyond this corrective action. It's trying to do something. I think that was really damaging to it. Has its work cut out, but at the same time, it wouldn't take much more of a move to be right back where it was after a shakeout, so to speak. And if that's the case, that could be something that allows it to go a little bit, where they really clean some clocks here, so to speak. And now they're ready to go on things. So we'll see. I don't know. I think there's a massive amount of funding that's coming up that the government needs to make, and it just keeps getting worse year over year because of the fantasy game that really we're all forced to play, and they're really leading. Let's take a look at that SMH because it's such an important sector, but I also want to look at the Mag 7 as a package. And here is the SMH, right? And so other than the fact that, right, it dipped down to the red 15 SMA, simple SMA, and then it started working its way back up. There's not a lot to complain about, right? It did get, as we were saying, it did get overbought. It was near 79, quite vertical. Unfortunately, I had an idea in there, but I don't even think people really had a great chance to make money. It was a counter trend idea, something I'm really not a big fan of overall, but I felt like there was a setup for it. We maybe got, I don't remember if anyone did okay on that one, but hopefully they did. It was just a little bit of a pullback, but that's really, I think, what you expect overall when you're fighting against such a strong trend. Get a little money and be happy with it, and just take it and run. Don't overstay your welcome at all, because they'll, again, very short order, they'll have you right back to where the weakness developed, and they did, right? They got it right back there. So now you've got to look out for lower high rollover, similar high rollover, similar high negative divergences. Do you take this out and go? Will it be extended when it gets up there? I mean, after this corrective activity, it helps to back it off from overbought, but still relatively overbought. But right, the NVIDIA earnings are coming up, right? And that could be the big thing to keep your eye on and say, well, if they're able to keep that thing buoyed, how much are semis really going to go down, right? And look at that. Everyone made comments on the high that day. Look at that. I mean, it's when we have projections from a long time ago in here, and you can see that it's almost at the 423.6% projection. Not quite, but almost there. And I'm pretty sure Broadcom, or formerly Broadcom, not even sure what's going on with, but they may have earnings. It's not listed here on Thinkorswim, but that may be, I guess that could be like an early March that would follow. But it's very similar looking charts to SMH. Hard to really say, well, it's time to fight against it. Oops, I don't have that. I meant to do NVIDIA anyway, but pretty hard to, in my book, to say like, hey, we got to fight against this right now. I don't like when things are making new all-time highs, that just because they're overbought, just start selling it. To me, like you're playing into the hands of these people. So let me just shut this thing down. Close that. Oops, cancel. Click the wrong one. Where's Telegram? Just close this down. I'm getting too many of those little pop-ups. Quit Telegram. Okay, hopefully that helps. But anyway, this is popping up towards that one in terms of that level, the 423.6 extension. That's pretty much up there. But I mean, who could be surprised if it does that? Who could really be surprised if that really starts to run to that point? So just the way it's been, and kind of how off I don't know. It's sort of an outer space sort of mindset right now, right? You're not really dealing with the normal fare. You're dealing with something that's just an extraordinary thing, and these things can persist. So I'm going to leave it at that on that, but that is pretty darn good right there. And again, I'm not picking a fight yet with it. Let me think of, I know I wanted to do the Mag 7. That's right. AAPL. Let's do AMZN. And this to me is, again, like I can understand where people are coming from. Like, how long can this last? And I skipped over Google again, like I always do. How long can this last, and all this type of stuff. But let me see here. Where am I at? I need Tesla, and I think NVIDIA. Sorry, I've got animals all around me. They're jumping on things. Because I can't keep them locked out of the room I'm in. I'm in their main room. So if you hear noises and playing and stuff like that, that's the reason why they're doing all kinds of things around here. So look, here's where they are. I mean, Meta's largely responsible for this. Is this thing extended? Sure, it really is. But just remember that big picture. Remember that big picture stuff, right? This is your super big picture, and it's just broken out. And right, this to me, just a very basic look at it, not at the moment, because yeah, I get that it's short term overbought, but to me, there's just even more upside here. You can't really rule that out, right? Because it extends that way. If you start putting extensions on that, it extends that way, and there could be a little bit of a mania developing here. You could get into a melt up at some point. Obviously, the risks are great. That's one thing we've covered this week. I just want everyone to know how risky the underlying situation is, because we're getting this detachment, right? We're getting a real detachment from, I think, the foundation, and it happens and it can persist. So we're in a very interesting and tough time for that reason. What I'm going to do is go through the sectors while we can, but again, like if you keep arguing, well, it can't just be the Mag 7, I've got a problem with this whole situation, and look how these things are performing. That's all there really is to it in the end. So here's XLE. Again, I think you got to keep an eye on the XLE at this point, trying to use the 20 and the shorties to kind of find support there. And it could be above all SMAs, and then it would be near the top of its range, and it could just try to go from that point. But we need to really see it to really feel better about this. I think you got to really see it take out that 150, 100 area. That's going to be right near 86. So up, you're going to be up a few more percent. But as of right now, rally, pullback. Can they try to get a second leg going to this rally and then really attack or challenge these former high area near 26? That would be big, right? Otherwise, you could say, well, we're still in a downtrend. And you are, right? You don't have a higher high to say, no, maybe we're not. You've got nothing but a lower high and maybe a higher low, maybe now. So right now it's not really overbought, right? So you're kind of neutral. So you should be okay if they want to try to do something, but that would be a helpful part of it. Let's see, XLK, this is going to look tremendous. And because of it largely mimics the Qs and the SMH and so on and so forth. So you've got that looking really, really good. Close the gap. We got to be on guard for lower high, right? If there's suddenly some reason to sell, this could be a throw over here where we had this one trend line working and you got over that briefly, and now it could come up to there and fail. So again, I'd be on guard for that. But overall, if you just look at it, bounces off the 50, incoming trend, strong corrective action, gets above here and breaks out, right? You break out above there, you have to start thinking, well, what if I extrapolate this trend and you've got more upside? That's what I keep seeing, right? You could say, well, there's problems, and there are, but I keep seeing that there's more upside potential. So, excuse me. XLC, the meta situation obviously produced this, right? And now it sort of has left that channel, that sort of wedge that it was working in, and it's gone bonkers, and got up to 81 on RSI there. Now we're currently at 72 because it did correct down. Kind of when I saw that SMH paper, this also kind of pulled back, but it just not too much, but it took out some of that overboughtness from it. So that's that one right there. Let's see here. I'll go back to, let's do XLF will do. And this has been a very strong. You barely off the highs. We put a couple bears in here thinking there could be a little pullback, counter trend ideas, and they might have worked a little bit, but then we were just right back to some bullish ideas, not back at the all-time high, right, but kind of closing in on it. But once we set it back here, right, it really broke out. And on the weekly basis, you get the really strong run, you get the corrective pause really there, and they reestablish the trend, and they're working their way up. So is it overbought? Sure, it's at 73 on the weekly, so a little bit more hefty than the daily. And on the daily, it's a 68. So it's getting overbought. But as of right now, it's above all SMAs, all of which are rising. So you have positively sloped SMAs, and that's a good sign, I think, overall. but that's probably counterbalanced by other things. So XLRE, we can look at that one, right? This one to me, this and just overall this area to me should be lower, but they don't seem to be worried too much about it yet. You have the nice push. It worked well to the end of the year, but it's really struggled this year. So I think right now, what I would do, I would use the 20-day. May as well wait for that above that cyan or blue colored line, light blue, get above 39, let's say, or above the Friday low. And then I would trade it if it's in accordance with the market's wind. So if the market's wind is up north, right, pushing to the north, then I would go with it. And if it's not, I'd be willing to go the other way. Otherwise, it's probably not a great trader at the moment. So why am I going to force anything on in there? XLV, our healthcare. This one has been doing better. And I think this is a little concerning because this is now stretched at 69 on RSI. A little bit of negative divergence here on some of these indicators where they're not confirming this new high. So maybe just be on guard for that. But I think the main comment on this one would be, A, it is participating, but B, usually looked at as a little more defensive, just like staples, right? So staples have also been doing pretty well lately, right? They really powered up. So that's a little worrisome to me that XLV and XLP are doing well. You would not really expect that to be the case in most market phases and cycles and whatever the case, bull, bear cycles, whatever you want to call it, bull markets that I've been in, right? Usually these are kind of lagging behind. There's leadership sectors and but there could be good things going on in there. You don't want to kind of make that blanket statement, but just saying as a general principle, these are a couple of defensive areas and they're doing well. They're hitting or barely off new highs. So that's a little concerning, but that sort of makes sense because we've seen a market picture develop this week where, it's very, let's do the discretionary now. The market picture is very mixed. You can make positive and negative arguments right now. Here's your XLY. This was, again, probably concerning to me that it was not doing its thing, but they did break it out. Now it's above all SMAs. You can see that. Some of them are a little messy, but at the same time, right, at least it's trying again, and you keep your eye on it for that reason. If they start to re-engage this strongly with the market, that's a good sign, and it had a really strong incoming trend. You've gotten your corrective action. You got the 38.2% retracement. That's what you want to see as a bull. You could get back up there and go. So this now has sort of catch-up potential in it, where things are legitimately, and all these signs are missing it, but the economy is actually doing well or better than we think, at least me. Maybe this thing really starts to go. So we'll see. I mean, I think the fact that people are really, their saving situation's bad, really bad, and their revolving credit balances are really high and the rates are really high. I don't think that's good, but what do I know? So we are leaving off here. Yeah. So let's take a look at XTN. This is another of my important sectors. This too wasn't really doing that well, but much like the XLY, it started to get its act together on Friday, right? So again, another one where this had a 50% retracement and it's got this slightly higher low put in versus here. It's breaking out potentially of this. Let me just do this simple chart stuff, get a line on here. And you can see that it's there, right? And you got that flat line at about 81. You can see that from the 23.6 fib we've got there. You get through there, I mean, that's resuming, right, the trend after consolidating for, well, a little bit longer than a month. So with a higher low in place, and you could be taking out a high with any effort at all, right? You could be making a new higher high just by exceeding ideally closing above 80.42. I'm sorry, I got a little wrong number, 81.54. 81.54. So you're not very far away in there, and that would be a good sign. That would be a good sign, right? The transports, financials, and energy are all trying to get it together, because remember, we've been saying the market didn't look much better than it did late in the year of 2023. It looked so good, other than really energy and probably IWM, which was looking better, but not near the highs. But if without those two things were really the only major things I think missing for almost to be like market nirvana for bulls, market perfection. But now these things are like, obviously XLF is already doing it, but XTN, XLY are threatening to maybe rejoin the parade higher. And if they do, that's a really good sign. And that'll, I think, really dumbfound a lot of people that that's happening, right? So, but again, we got to watch the TNX, we got to watch the dollar to see, right, if they start to back off, that's going to help. Here's another one that could easily resume, right, an uptrend after correcting, and that's your XLB. So you get the nice corrective action. You hold the 150 there, rust colored, for a while. You start moving back up, and you're really close to being above all SMAs and maybe making a new recovery high since this low. And there's, I think, no, am I wrong on that? Is there a gap up there? It could be a minor gap up there too. No, it's only 3%. It is, but I'm not going to harp on that. But that could also very soon join the party. XLI seems like it started to do that already, right? So from my recollection, hopefully I'm not wrong on this one. Yeah, so there you go. I mean, that's, again, incoming uptrend, corrective action that ran its course for a while. This thing starts breaking out and making new highs. Some people still like volume to be heavy. Solid volume, better than light volume, I guess, but broke out, made a new high, other than maybe the things at 65 and only has a little bit of a potential before it reaches overbought status. Other than that, what's the problem with it? It sort of, to me, defies logic with rates being where they are. But again, trade what you see, not what you think. And that's what I would do, right? The charts are saying this thing is still uptrending. It's above all SMAs. So, and they're virtually all stacked and sloped positively. So not a lot to complain about there. Bigger picture wise, might be worth looking at. This can be a really good area to trade. And if I'm not mistaken, did we just close at an all-time high? And let's see if we did, and we did. Right. So this is, again, remember, this is still at a discount to the former high, which looks like it might have been right there. And that's 111 up there. Yeah, 111, 111, 111. So you're at an all-time high. Probably got to tack on even more to really account for inflation. So and again, if you look at the long-term bigger picture channel, and you can see that I've got the orange resistance line up there, basic technical analysis, we can add another one. I would still keep the one I've got there. I don't even want to go into why, because this video is already exceedingly long. I'm trying to get a good fit on that, but there's another one, right? Even to that line, which is the lesser line, there's still a lot of potential. So that's why you see what I wrote on those charts. Let me see on the PowerPoint. I still see a lot of potential there, and the market and stocks find a way to reach it. And in the face of so many things, and we only cover the XLU really to be thorough, but what are you going to say about this right now? I mean, it was definitely doing better when rates were going lower. Now that rates have sort of hung in there a little bit, it hasn't been doing so well. But if this starts to go, that maybe look to rates. If rates are coming down and this starts to go, it's just a good sign overall, obviously. But if this is going up and rates are not coming down, in fact, are going up, then that's really more defensive stuff, right, that's happening. So just keep your eyes out for that. Let's take a look because we did talk about energy. Let's take a look at light sweet crude. And we're on daily here. And this is, right, this really it looks like it had a really rough Friday and a rough week overall. So you're right back down. So, right, unless you start to see that hold and reverse, it probably means it's going to be tough for the energy sector to do its thing. We had copper. We've looked at that here and there when we can to try to see if that's showing anything good. And, again, it's kind of been dead in the water. And the good thing is that it's consolidating for such a long time that if it does ultimately break out, hopefully, right, that means there's good things happening in terms of global demand. Let me see. We were doing wood, cotton wood, and XHB when we were getting into this a little bit more. I'll try to cover those quickly. So, again, that to me, like the way that I'm reading things in the housing market, I just don't see how it maintains itself. At the high levels. These two ETFs are telling you that lumber's been getting shillelied now for a while, several months, and XHB is hanging in there. So again, this is why we trade the charts. And I'd be, as much as to me, it's a head scratcher overall. That's probably because there's dots I'm just not connecting, right? Because I just don't have the time to do that. Don't want the percentage. But look, this thing's very strong uptrend, right? Incoming uptrend, consolidation, holding on to gains, not even really giving, probably not even having a 38.2% retracement, holding on. And I wouldn't be surprised, right, if they start to try to get it to go again. There's big demand in certain parts of the country, and maybe these builders are there's existing being sold at places where they're leaving, and then they're going into new, maybe, and that could be it. But that's where, right, if you're into sector analysis, or you like to focus on just a sector or two, that's where that would really help you, is to know, well, no, this really is, you feel better about your longs and being patient with them on a little bit more than a swing trading, more like an intermediate term trading basis if things were good. But technically, I don't really know. I can't say bad things about it. What can we really say other than it's corrected? It's held most of its gains, which is normally a good sign. And overall, right, it's just barely off the all-time high. And it too had a bullish, bigger picture chart, much like, we've seen. And that, by bigger picture, I mean the last several years on the weekly or monthly. So that sort of cup and handle action we talked about that we've seen so many places. So really, I say bad things about it all the time, and it kind of bewilders me. But again, it's probably because I'm not connecting dots. I mean, I would defer to the market on this one, because the market follows that more closely than I do. But very good overall. Again, I'd be willing to trade it. When I see home builder calls come in, as long as it's not already stretched, I'm willing to get that into our log and trade that. That's how I handle that. Let me think if there's anything else that we typically cover that I haven't. Oh, we can take a look at XAU. That's another one. And as I mentioned, I think there's massive value right now in terms of historically. We saw a little tab on that, I think, in terms of value. So, this thing's been, again, we keep saying the same things, but we check on it usually week in, week out when we're doing both videos. But here and there of late, we've checked on it. And it's just off, right? Just barely off of a 2-week low, right? Based on Friday. It's off of that a little bit, but what do you like about it, right? Like it's other than it's consolidating, and maybe that sets it up for a big picture move, right? It's just not there, that everything hasn't fallen in place. Like I kept saying that for the longest time, that I just want to see bigger picture stuff fall in place so we can feel better about it. And we haven't gotten it yet. Now, with the way the world's going, I could see, and the fact that it's probably really undervalued, I could see it catching a bid at some point. But I think you have to wait for that. I mean, what I would wait for at this point is that it gets above the 200-day, the 200-day in the XAU, and that's up there near 120. And that means it's got to go up several percent before I start feeling even better about it. It doesn't mean you can't take a little short-term pop trade. It's just that you're not really, I guess you could say, stacking probabilities if you believe in technical analysis, because you're willing to accept very subpar technical analysis in terms of its current complexion to go long. I don't think there's anything great about going long here. The way that I like to chart. So I would want to see better price action from it to believe in it more. These low, the good thing is this low cleaned out some people that were trading against this low. So they did flush some people out, it might have flushed some people out here against some of these lows that they had for a while and then reversed it back up. So they might be doing some of that, but overall, it's just not, it's not anything exciting. And this is something that can turn on a dime due to geopolitical. But gold and silver, to me, if they start coming more in line, they could be in trouble with what's going on in XAU overall. But gold looks a little better than silver clearly, but this just doesn't look that great. Let's just, if there's going to be the big pop that a lot of people keep banging the table for, then I think the smart move is to let it show you a little bit more. Now, if you're just a hedger like me, where you just think it's smart to have a certain percent of your holdings in these, then it's different. I've got money in both of them, not SLV and gold, but in both metals with physical and other exposure, just as a hedge. It's just, to me, as a percent of what I've got overall invested, but it's a hedge just against these governments really going crazy with money printing, which they might be getting to that point where it starts to really get super, super beyond comprehension excessive, even more so than it is now. We'll see, but I hold them. Now, that's a different story. I would just buy some and see what happens. If it goes lower, buy more. If it goes higher, buy more. Just get started and average your way in, and it doesn't really matter. But I felt like when I bought it a couple of years ago, it was a good time to buy it. It turned out that it was. I just wish it would have gotten a little cheaper. Maybe it still will, but it didn't get cheaper for me and in a big way yet. So I'm just waiting it out. But I would definitely trade it if it starts getting above that 200 and that 50, and that in this case for SLV is 2155, near that area, and gold GLD. You probably want to see the high get exceeded, right? At least that was doing better, but that could be a problem. But you got to keep your eye on the dollar. These are usually pretty good in terms of being inverse. So it could be you can see that with the dollar, that big dollar reversal, that could be an issue, like we talked about earlier. So if that starts reversing, right, then it really starts to tilt even more stuff on the side of this market's really whistling past a lot of problems. And now the dollar's, strong, maybe yields are up. Now you've got even more trouble building on that side of the ledger. So we'll see. I don't think there's anything at this point that I didn't really cover. But I'm really sticking with our plan of I think you've got to appreciate where you are. And I think where you are right now is there's plenty more upside on these charts. If the momentum stays in place, then go ahead and trade it, but realize, right, that the risks are building, and you're better off though buying this kind of early hype. Many times there's been a lot of hype, and then it turns out to have legs later when there really weren't many signs of it while it was being hyped at a fever pitch. But again, for trading, that's for trading. For investing, it's probably also true. But again, you really have to, I think you've got to use your options, and you just have to be a smart and disciplined roller. And that's how you avoid getting really misled, where you do a lot of really great work to stay long, get long, stay long, remain long, make adjustments on the long side. And if you don't do that one last time and you kind of let it get away from you, and there's a big push higher and you're doing great, but you don't roll, then you can give a lot back. Because when things get really vertical and overbought, they put an exclamation point, kind of like on a melt up, they can also fall apart very quickly. And they kind of lure people into a false sense of security where it doesn't just immediately reverse. It kind of meanders for a while. And then figuratively speaking, when people are out to lunch, that's when they do the rug pull. I mean, I've seen it many times where when people feel like the market's really, it's kind of boring. There's been a great run. I'm going to be able to I made some good money. I'm going to just step away for a little while. Then they somehow get you. It's kind of uncanny, but that's how they do it. So I think I'm going to have to end on that. I'm getting all kinds of animal participation in the entertainment, cats chasing things, jumping on things, all that kind of stuff, looking at animals all around us that are flying and crawling, and these cats are starting to lose their patience. So I'm going to have to wrap it up on that. Sorry for the super long video, but again, I kind of want to reacquaint ourselves with a lot of things, make sure everybody was being smart about stuff as best they can, appreciating the risk that we have right now. So I want to thank everyone for tuning in. I do hope something that I share with you helps you out this week or some week in the future. And hopefully it won't be too long before we're back to 2 shorter videos. So everyone, take care. Have a great week ahead. Have a great conclusion to your weekend. Thanks for tuning in.